You see, the market has a way of testing a man that no teacher ever could. It doesn't just take your money when you're wrong. It takes your peace of mind. And if you've spent any real time in trading, you already know this. The ticker doesn't shout at you, but somehow it gets inside your head all the same. Ever noticed how a quiet chart can feel louder than a crowded room? Stress in trading isn't an accident. It comes from uncertainty, from risk, from not knowing whether the next move will reward you or punish you. But let me tell you something plainly. The market itself is not stressful. It is the man who trades it without a plan who feels the strain. Have you ever entered a trade without truly knowing why, and then sat there watching every tick like it was life or death? That's not trading. That's hoping. And hope in this business is expensive. A man who understands his position, who knows why he's in, where he's wrong, and what he stands to lose. That man sleeps better, even with money on the line, because his mind is settled before the market ever opens. Stress doesn't come from the position. It comes from doubt. So I ask you, when you place a trade, is your mind already decided, or are you negotiating with yourself after the fact? You see, I learned early that the real battle in trading is not between you and the market. It's between you and your own impulses. The market merely reveals them. When prices move against you, do you act with reason, or do you feel that tightening in your chest, that urge to fix the trade quickly? That feeling, that's where most fortunes are lost. The tape doesn't care about your comfort. It doesn't adjust because you feel uneasy. So if your method depends on how calm or anxious you feel in the moment, then you are not trading the market. You are trading your emotions. And emotions, my friend, are the most unreliable indicators ever created. Now think about this. Why does a small loss feel unbearable, while a larger planned loss feels manageable? It's the same money, isn't it? No, it's not. One is controlled. The other is chaos. When a man risks more than he has decided beforehand, he invites stress into the room. He sits there watching every fluctuation, hoping for relief instead of following logic. But when the risk is defined, truly defined, then the mind is free. The trade either works or it doesn't. There's no argument left to have. Have you ever noticed how the best trades feel almost quiet? No panic, no rush, just a steady unfolding. That's not luck. That's alignment between your plan and the market. Stress often comes from overtrading too. A man thinks he must always be in the market to make money. But the truth is, most of the time, the right position is no position at all. Sitting tight is harder than trading. Why do you think so many fail at it? Because doing nothing feels like missing out. But missing out is cheaper than being wrong. If you jump into every movement, chasing every swing, your mind never rests. You're constantly reacting, constantly adjusting, constantly questioning yourself. That's not a strategy, it's exhaustion, and an exhausted trader makes poor decisions. Let me ask you, how many of your bad trades came after a series of smaller ones? When your mind was already tired, already stretched thin? You see, stress compounds. It builds quietly, trade after trade, decision after decision. And then one moment comes, a larger position, a faster move, and suddenly you're not thinking clearly anymore. You're reacting. That's when the damage is done. The wise trader understands that preserving mental capital is just as important as preserving financial capital. If your mind is clouded, your judgment is compromised. And if your judgment is compromised, your edge disappears. Now consider this. Do you watch the market, or does the market watch you? A man who constantly checks every tick, every fluctuation, every minor move, he is not in control. He is being controlled. The market dictates his mood, his thoughts, even his decisions. That kind of attention breeds stress, because it keeps you tied to noise instead of meaning. The real money, as I've said before, is made in the sitting. But sitting requires confidence, and confidence comes from preparation, not from watching every tick like it holds a secret. The charts tell their story in patterns, in structure, in behavior over time. But if you stare too closely, you miss the bigger picture. And missing the bigger picture leads to uncertainty. And uncertainty leads to stress. So I ask you again, are you trading what you see or what you feel? There's a difference. A trader who follows his system who trusts his method, who accepts losses as part of the game. The trader operates with a certain calm. Not because he's fearless, but because he's prepared. He doesn't need the market to behave a certain way to feel secure. But the man who needs every trade to work, he is always under pressure. Every position becomes a test, every loss becomes a threat, and over time that pressure builds until it breaks him. Stress, then, is not the enemy, it is a signal. It tells you something is wrong, not with the market, but with your approach. Maybe your position size is too large, maybe your rules are unclear, maybe you're trading too often, or maybe, just maybe, you're trying to force the market to give you something it's not ready to give. The seasoned trader doesn't fight stress directly. He removes its causes. He reduces size when needed. He steps away when the market is unclear. He waits when there is nothing to do. And most importantly, he accepts that uncertainty is part of the business. Not something to be eliminated, but something to be managed. Because in this game, certainty is an illusion, and chasing it will cost you dearly. Now tell me, when you sit in a trade, are you at ease because you trust your process, or are you tense because you're hoping to be right? Stress comes from uncertainty, not the market itself. The market, by its very nature, is neutral. It moves as it always has, up, down, and sometimes nowhere at all. It does not know you, it does not care about you, and it certainly does not aim to disturb your peace of mind. Yet you feel that tension, don't you? That uneasiness when price begins to move, and you are not quite sure what it means for your position. Now ask yourself this: if the market is the same for everyone, why do some traders remain calm while others feel overwhelmed? The answer lies in uncertainty. A man becomes stressed when he does not know what he is doing. When he enters a trade without a clear reason, without a defined plan, he places himself at the mercy of every tick. Each movement becomes a question. Each fluctuation feels like a threat, and the mind, having no solid ground to stand on, begins to wander. It starts asking, should I get out? Should I hold? What if I'm wrong? That is not the market speaking. That is uncertainty. When you do not know where you are wrong, every small move against you feels larger than it is. A minor pullback becomes a warning sign. A brief consolidation feels like a reversal, and suddenly, you are no longer reading the chart. You are reacting to your own fear. Have you ever noticed how the same price movement can feel completely different depending on your level of preparation? If you enter a trade with a clear setup, a defined entry, and a known exit point, then the movement of the market becomes easier to interpret. You expect fluctuations. You understand that prices do not move in straight lines. Your mind remains steady because you have already accepted the possible outcomes. But if you enter without that clarity, every movement becomes personal. You begin to interpret normal market behavior as something abnormal. You start searching for answers in places where there are none, and that search creates stress. You see, uncertainty forces the mind to work overtime. It keeps you alert, but not in a productive way. It drains your energy, clouds your judgment, and makes simple decisions feel complicated. And in trading, a complicated mind is a dangerous thing. Now consider this: why does a trader feel calm after placing a well-planned trade, even though money is at risk? It is because the decision has already been made. He knows why he is in the trade. He knows where he will exit if he is wrong. He understands the structure of the chart and the behavior of the market. There is no need for constant questioning because the answers were decided beforehand. But the uncertain trader, he is constantly negotiating with himself. Every tick invites a new opinion. Every candle creates doubt, and that doubt builds pressure. You cannot trade effectively while questioning every move. The charts provide information, but they do not provide certainty. No pattern, no indicator, no signal can guarantee an outcome. The experienced trader understands this. He does not seek certainty, he seeks probability. And because he accepts that he can be wrong, he prepares for it in advance. That preparation is what removes stress. So let me ask you, when you feel stressed in a trade, is it really the market causing it, or is it the lack of clarity in your own approach? Because the market will always be uncertain. That is its nature. But your process does not have to be. A defined risk removes emotional pressure from a trade. That is something a man only truly understands after he has felt the weight of an undefined loss. When you step into the market without deciding what you are willing to lose, you are not making a trade, you are making a gamble. And a gamble carries a certain kind of tension, doesn't it? Think about it. When you don't know how much you might lose, every tick against you feels dangerous. The mind begins to imagine outcomes. Small losses appear manageable at first, but as price continues to move, doubt creeps in. You hesitate. You wait. You hope. And all the while, the pressure builds. Now let me ask you, have you ever held onto a losing position longer than you should have, simply because you hadn't decided where to get out? That is what undefined risk does. It removes your ability to act decisively. You are no longer following a plan. You are reacting to discomfort. And discomfort, in trading, rarely leads to sound judgment. But when a man defines his risk before entering a trade, something changes. He sets a point on the chart, a level that tells him, if price reaches here, I am wrong. Not maybe wrong, not temporarily wrong, just wrong. And once the decision is made, there is no argument left to have with the market. The loss is already accepted. Do you see the difference? It is not the size of the loss that creates pressure. It is the uncertainty around it. When you know exactly what you stand to lose, your mind is no longer occupied with fear of the unknown. The outcome has boundaries. The risk is contained, and a contained risk is a manageable risk. Now consider how this affects your behavior while in the trade. If your stop is clearly defined and your position size is appropriate, you are free to observe the market objectively. You can read the chart as it unfolds, rather than as you wish it would unfold. You are not forced into impulsive decisions, because the decision has already been made. But if your risk is undefined, you watch the market differently. You are not observing, you are hoping. Every move against you feels like a threat to your capital, and every move in your favor feels like temporary relief. Your focus shifts from reading the market to protecting yourself from it. That is where emotional pressure comes from. A trader under pressure is a trader who will eventually make a mistake. He will exit too early out of fear or hold too long out of hope. He will second-guess his decisions, adjust his positions without reason, and abandon his method at the worst possible time. And all of it begins with one simple failure. He did not define his risk. Now ask yourself this. If you already know the maximum you can lose on a trade, what is there to fear? The market can do what it wants. It can move against you, test your entry, even stop you out. But none of it is a surprise. You anticipated the possibility before you ever placed the trade, and because of that, your mind remains steady. This is not about eliminating losses. Losses are part of the game. No man avoids them. But there is a world of difference between a planned loss and an uncontrolled one. A planned loss is clean. It is quick. It is accepted. An uncontrolled loss lingers. It grows. It creates tension, hesitation, and eventually regret. And regret is far heavier than any loss. You see, the professional does not measure his success by how often he is right. He measures it by how well he manages when he is wrong, and that management begins before the trade is even placed. So when you prepare for a trade, the first question should not be, how much can I make? But rather, how much am I willing to lose? Because once that answer is clear, the emotional burden begins to lift. The trade becomes a decision, not a dilemma. The outcome becomes acceptable, not threatening. And with that acceptance, the mind finds a kind of quiet that most traders never experience. Overtrading is one of the fastest ways to exhaust your mind. A man may think he is working harder, staying active, chasing opportunity. But what he is really doing is draining his ability to think clearly. The market does not reward activity, it rewards patience. Yet how many traders confuse motion with progress? Let me ask you, have you ever taken trade after trade, not because the setup was perfect, but because you felt the need to be involved? That feeling is dangerous. You see, every trade you take requires a decision. Every decision uses mental energy. You analyze the chart, choose an entry, manage the position, and deal with the outcome. Win or lose, your mind is engaged. Now imagine doing that over and over again, without rest, without selectivity. What happens to your judgment? It weakens. At first, you may not notice it. The early trades feel sharp, calculated. But as the day goes on, the quality begins to slip. You start seeing setups that aren't quite there. You justify entries you would have ignored earlier. You react faster, but think less. That is exhaustion at work. The mind, like any tool, dulls with overuse, and a dull mind in trading is costly. Because when your thinking slows down, your emotions speed up. You begin to act on impulse rather than observation. Now consider this. Why do traders often take their worst trades after a series of earlier ones? It is not coincidence. It is fatigue. Each trade, whether successful or not, adds weight to your mental state. A few small losses can create frustration. A few wins can create overconfidence. Either way, your balance shifts. And when that balance is gone, your decisions are no longer grounded in the chart. They are driven by what you feel. Have you ever found yourself entering a trade just to make back what you lost earlier? That is not strategy. That is reaction. Overtrading feeds this cycle. The more you trade, the more emotionally involved you become. And the more involved you are, the harder it becomes to step back and see the market clearly. The seasoned trader understands that not every moment is meant to be traded. In fact, most moments are not. The market spends a great deal of time moving without purpose, creating noise that tempts the impatient. But noise is not opportunity. The man who trades every move soon loses the ability to distinguish between the two. Now ask yourself, are you trading because the setup is there, or because you feel like you should be doing something? There is a difference. The best trades often require waiting. Waiting for the right price, the right structure, the right confirmation. And waiting, for most, is uncomfortable. It feels unproductive. It feels like missing out. But it is in that waiting that clarity is preserved. When you limit your trades to only the best opportunities, your mind remains sharp. Each decision carries weight. Each position is taken with purpose. You are not scattered, you are focused. But when you trade excessively, everything blends together. Wins and losses pile up, and your perspective becomes clouded. You stop learning from each trade because you move too quickly to the next one. And without reflection, there is no improvement. Overtrading also distorts your sense of risk. Small losses may seem insignificant at first, but they accumulate. Not just in your account, but in your mindset. Each loss adds pressure, even if you try to ignore it. And that pressure eventually influences your next decision. A tired trader is more likely to increase size at the wrong time, to chase a move that has already passed, to ignore a rule he would normally respect. That is how damage is done, not in one large mistake, but in a series of smaller ones made under fatigue. The wise trader knows when to stop, not because the market has closed, but because his mind has reached its limit. He understands that preserving clarity is more valuable than squeezing out another trade, because one good decision made with a clear mind is worth far more than 10 made in exhaustion. So tell me, when you sit in front of the chart, are you choosing your trades carefully, or are you letting the market pull you into every move it makes? Hope is not a strategy, it is a liability in trading. A man who trades on hope is not following the market, he is arguing with it. And the market, I assure you, does not argue back, it simply continues in its own direction. Now let me ask you something. Have you ever stayed in a losing trade, not because the chart told you to, but because you believed it would turn around? That belief, that quiet insistence that things will improve, that is hope at work. At first, it feels harmless. The price moves slightly against you, and you tell yourself it's just a temporary pullback. You've seen this before, haven't you? The market dips, then recovers. So you wait. You give it a little more room. You convince yourself that exiting now would be premature. But the market doesn't respond to your patience. It doesn't reward your belief. It simply continues to move. And as it does, your position grows heavier. Hope has a way of keeping a man in a trade long after the reason for entering it has disappeared. The setup is no longer valid. The structure has changed. The behavior of price no longer supports your idea. Yet you remain, not because of logic, but because of expectation. You expect the market to come back. But tell me, on what basis? Is it in the chart? Is it in the volume, the trend, the behavior of price? Or is it simply in your desire to avoid taking a loss? You see, hope often disguises itself as patience. A trader tells himself he is being disciplined, that he is giving the trade time to work, but true patience is based on a valid setup still being intact. Hope, on the other hand, ignores what is actually happening. There is a difference between waiting for a trade to develop and refusing to accept that it has failed. The hopeful trader cannot make that distinction. And so he stays. Now consider what happens next. As the loss increases, so does the emotional pressure. You begin to watch every tick more closely. You start calculating how much you are down, how much you need the market to move just to break even. Your focus shifts from reading the chart to escaping the position. Have you ever caught yourself thinking, "If it just comes back to my entry, I'll get out"? That is not strategy. That is negotiation with reality, and reality in trading does not negotiate. Hope also affects your entries. A man may enter a trade without a clear signal, simply because he believes something will happen. He anticipates rather than reacts. He guesses instead of observing, and when the trade does not behave as expected, he falls back into the same cycle, waiting, hoping, holding. This is how small losses turn into large ones. Because hope delays action. The professional trader does not rely on hope. He relies on evidence. He studies the chart, identifies patterns, waits for confirmation, and acts when the conditions are met. And just as importantly, he exits when those conditions are no longer present. There is no room for hope in that process. Now ask yourself, when you are in a trade, are you responding to what the market is showing you, or are you holding on to what you wish it would do? Because those two paths lead to very different outcomes. Hope keeps you tied to the past, to your entry price, to your original idea, to what you thought would happen. But the market only moves forward. It does not care where you entered. It does not remember your reasoning. It only reflects what is happening now. A trader who understands this is quick to admit when he is wrong. Not because he enjoys losses, but because he knows that accepting a small loss is part of staying in the game. He does not wait for confirmation of failure. He defines it in advance. And when that point is reached, he acts. No hesitation, no negotiation, no hope. Because he knows that hope, in this business, is not just unhelpful, it is costly. Emotional trading begins where planning ends. That's the line most men cross without realizing it. They believe they are still following a method, still acting with reason. But in truth, they have stepped beyond it. And once that line is crossed, the market is no longer being read clearly. Let me ask you, before you enter a trade, do you already know exactly what you will do if the market proves you wrong? Or do you wait to decide in the moment? Because that moment, that's where emotion takes control. You see, a well-planned trade leaves very little room for interpretation. The entry is defined. The risk is defined. The conditions for staying in or getting out are already decided. There is no need to think under pressure, because the thinking has already been done. But when a man enters without that clarity, he leaves decisions open. And open decisions invite emotion. At first, it may not seem like much. The trade is placed, the market begins to move, and everything feels manageable. But then price does something unexpected. It hesitates, or pulls back, or moves slightly against your position. And now, instead of following a plan, you are forced to decide. Should you hold? Should you exit? Should you give it more room? These questions don't arise in a planned trade. They arise in an unplanned one. And once you start asking them, you are no longer trading the market. You are reacting to it. Now consider this. Why do two traders see the same chart but act differently? One follows his rules. The other hesitates, adjusts, second guesses. The difference is not in the chart. It is in the preparation. A man with a plan does not need to interpret every movement. He understands what matters and what does not. He can ignore noise because he knows what he is waiting for. His actions are consistent, not because he is always right, but because he is always prepared. But the man without a plan, every movement matters to him. Every candle seems important. He cannot filter the noise because he has no framework to do so, and so he reacts, quickly, often impulsively. That is emotional trading. Have you ever moved your stop loss further away just to avoid being taken out? Or closed a trade too early because you felt uneasy, even though the setup was still valid? Those actions don't come from the chart. They come from discomfort. And discomfort fills the space where planning should have been. The market will always present uncertainty. Prices will move in ways you did not expect. That is part of the game. But a plan acts as a guide through that uncertainty. It keeps your decisions grounded, even when the market is not behaving perfectly. Without that guide, you are left to rely on instinct. And instinct, in trading, is often shaped by fear and greed. Now ask yourself, when you are in a trade, are you following a set of rules, or are you making decisions as you go? Because those two approaches lead to very different results. The man who plans accepts that he cannot control the market, but he can control his actions. He defines his behavior in advance, so that when the moment comes, he does not have to think, he simply executes. But the man who does not plan, he is constantly thinking, constantly adjusting, constantly reacting. His decisions change from moment to moment, depending on how he feels. And feelings, as I've said before, are unreliable. They shift with every tick. Emotional trading is not something that appears suddenly. It creeps in quietly whenever structure is missing, whenever rules are unclear, whenever discipline is replaced by flexibility, and once it takes hold, it becomes difficult to recognize. Because every decision feels justified in the moment. But justification is not the same as logic. A trader may tell himself he is adapting, that he is being flexible, that he is responding to the market. But in reality, he is abandoning consistency. And without consistency, there is no way to measure what works and what does not. So let me ask you again, when the market begins to move, are you executing a plan or are you creating one on the spot? Position size directly affects your mental stability. That is a truth most traders learn the hard way. They focus on entries, on patterns, on signals, but overlook the one factor that quietly controls their behavior once the trade is live. Let me ask you, have you ever taken a trade that looked perfectly fine on the chart, but the moment it started moving, you felt uneasy? The setup didn't change. The market didn't suddenly become different. Yet your reaction did. Why? Because of size. You see, when a position is too large for your comfort, the mind begins to distort what it sees. A normal fluctuation feels exaggerated. A small pullback feels like a reversal. You stop reading the chart objectively and start interpreting it through the lens of fear. And fear in trading alters perception. A man who risks too much cannot think clearly. He watches every tick, not because it holds meaning, but because it threatens his capital. His attention narrows. His decisions become reactive. And soon, he is no longer following his plan. He is trying to relieve pressure. Now consider this. Why does the same trader handle a small position calmly, but panic with a larger one? The market hasn't changed. He has. When the risk is small relative to his capital, he can allow the trade to develop. He gives it room. He respects his stop. He thinks in terms of probabilities. But when the size increases beyond what he is comfortable with, his focus shifts from process to outcome. He needs the trade to work, and that need creates tension. Have you ever found yourself closing a trade too early, not because the chart told you to, but because the profit felt too important to lose? Or holding on to a losing trade longer than planned, simply because the loss felt too large to accept? That is the influence of position size. It turns ordinary decisions into emotional ones. A proper position size, on the other hand, keeps the mind steady. It allows you to think clearly, to follow your rules, to act without hesitation. You are not distracted by the magnitude of the potential loss, because it has already been accepted. And acceptance is what brings stability. Now ask yourself, when you enter a trade, are you comfortable with the risk, or are you hoping the market moves quickly in your favor? Because if you are hoping, then your size is likely too large. The seasoned trader does not measure position size by how much he wants to make, but by how much he is willing to lose without disturbing his judgment. He understands that preserving clarity is more important than maximizing profit on any single trade. Because one clear decision leads to another, but one emotional decision often leads to many more. Position size is not just a number. It is a reflection of discipline. It shows whether a trader is thinking in terms of longevity or immediacy. The man who sizes correctly is playing a long game. He knows that consistency over time builds wealth. But the man who oversizes is chasing results. He wants more faster. And in doing so, he places himself under pressure that the mind cannot sustain. Now consider how this plays out over a series of trades. A trader who uses proper size can take losses without disruption. He remains steady, continues to follow his method, and waits for the next opportunity. But the trader who risks too much, one loss affects him deeply. It shakes his confidence. It influences his next decision. And often, it leads to further mistakes. That is how a single error grows into a larger problem, all because the initial position was too large.